Hey guys, welcome back to Be Rich. Before we get into the video, I wanted to bring to your notice that my uncles Vinod Srinivasan, Anand Srinivasan and I have rolled out our Substack, which is basically a blog / newsletter where we're going to post our original research onto it. And we've analyzed macroeconomic trends. And a lot of you know my uncle Anand Srinivasan and I regularly write for The Hindu, and these articles are also going to be made available for you in the Substack. The link is moatinvesting.substack.com. You'll find it in the description and in the video right now. We hope you go check it out. We've put a lot of time and effort into it. And please give us comments and feedback on what you read. Thank you. Hey guys, welcome back to Be Rich. Today we're going to be talking about, or rather exploring, what are some of the possible ways in which the S&P 500, NASDAQ, as well as other global markets, including our own, how can they be challenged in the upcoming months? What are some hurdles which they'll have to get past in order to continue the magnificent bull run which they had for the past few years? So, importantly enough, we need to understand the fact that markets are not immune to all sorts of macroeconomic as well as socio-political conditions. So, it's important to understand the fact that you have many other stimulus which could pose a threat to the market and jitter your regular investor. And most importantly, it's not retail investors who are crashing the market. It's rather institutional investors who are pulling out in big numbers. And it's when these people pull out is when you see the market start falling. And that's when the market crash happens. So the anatomy of a market crash is basically when there is some information or some starting point which has triggered an entire panic, and as the most leveraged people who can't even take a little bit of a price drop get out first, then when these people get out, the price goes down, and as the price goes down, those who are a little stronger than them end up having to get out because now they become weaker, and then the chain effect goes, and it reaches the point where even the strongest of investors, and that is institutional investors, have to end up getting out of the market. And then it's a rush to the door to see who can get out first. And that's futile because no one actually gets out first. You just jam the door and all of you burn in the building. This is the anatomy of a market crash. So what we saw very recently was a panic. People dropped the shares immediately, wanting to be the first one out the door. But then you had some sort of resilience in the market where the panic didn't set in completely, and we saw a sort of recovery in the markets. However, it's also true that this doesn't mean that the troubles for the markets are gone. So on August 2nd, we basically had unemployment data as well as economic data from the US, which told us that a recession is not off the table. Well, that's what the market interpreted the news as anyway. It said the recession may not be off the table, and that's what investors thought. And because investors thought this, they wanted to de-lever themselves and get out of a few risky positions, unwind certain very crowded investments they've made. So companies like Nvidia are extremely crowded because if any fund manager wanted to beat the market, any hedge fund manager or a regular equities mutual fund manager wanted to beat the market, the first thing they'd have to do was heavily be invested in these magnificent 7 companies. Because if you wanted to outperform the S&P 500, you had to have a larger position in these magnificent 7 than the index itself. That's the way you do better, because the index actually remained flat without the magnificent 7's rise. So if you were an active fund and you wanted to beat the index, you had to be heavily concentrated in this magnificent 7. So we saw that these investments were quite crowded, with people aiming to beat the larger market. However, the downside risk to it is that when you have a lot of people concentrated somewhere, there's going to be a lot of leverage. And generally, where a lot of people are concentrated, returns tend to be lesser and lesser as the price goes up, because there's only so much money to be pumped into a certain stock or a certain area of the economy. So we did see that artificial intelligence euphoria sort of ran ahead of, or rather prices ran ahead of this artificial intelligence story. And as soon as prices ran ahead, we saw these tech companies first correct before the S&P 500 corrected. And once tech companies started correcting, there was no stopping it, with certain chip companies in Japan going down 17-18%. And it was a worrying sign for the general economy. And when the yen started strengthening, we saw an unwinding of what you call carry trades. If you aren't aware of what they are, please refer to yesterday's video. But an unwinding of carry trades basically meant there was going to be a greater sell-off in certain equity companies. So, that being said, where do we stand today? What are some threats for the market which can be foreseen? Is this just a panic? Has it surpassed? Yesterday we said that no, it's difficult to say whether the panic has passed. And we said that an expensive market doesn't need any reason to correct during an economic slowdown. And today, the S&P 500 is still at one of its most expensive points relative to earnings in its entire history. So we are not out of the neck. We're still not out of the woods yet. And there's still more to see. Although I did say there was no reason which was needed inherently for a market to correct, like in that situation, how about we look at some reasons why the market may end up correcting, and let's see what could be one of the causes. Well, the most important cause is, or the most visible cause is the fact that if any one of these panics end up coming again and end up continuing, let's say any small event triggers a panic, we might end up seeing big leveraged positions delever, and delevering always causes exodus, or rather an exit from a certain stock or a certain group of stocks, and this causes the price to crash. And then, like I said, the cascading effect continues. This is one big thing to watch out for. And surprisingly enough, when the market cracked, gold prices also went down. Gold is supposed to be a safe haven.
Usually it's supposed to rebound.
Yeah, it's supposed to go up when markets are worried, because people want to stay in gold.
Treasury bonds also.
Yeah, but treasuries remain flat. Gold actually went down. That tells me that maybe people are having to sell positions which they would rather be in, because they have to compensate for the positions which are loss making.
Correct.
And that's a scary thought for those institutional investors or individual investors who are doing so.
Yes.
Because you have
we're throwing the house silver out.
Yeah, like what Warren Buffett said, if you keep buying things you don't need, one day you might have to sell the things that you do need. And that may be what's happening in the market, or what's happening in the market.
Because gold price turning soft was weird.
Yeah, it was very weird. It was an anomaly. Yes, it could just be noise. There's no telling that it's only because of this we saw gold prices fall. But I'd like to think that this is one certain possibility, that we are seeing a lot of leverage in the market, because even though interest rates are quite high, people are expecting the interest rate to fall. And there's still a lot of leverage from before, because we had 0% rates for over a decade now.
There's so much of cash and so much of liquidity. Even people who created the liquidity do not know where all the liquidity is.
Yeah. So there's so much liquidity that just 1 year of holding rates at 5.25% is only preventing more liquidity from being generated, but it doesn't really siphon off what was already there before. That is a difficult task which the Federal Reserve has to do. So that being said, today, if panic sets in, and panic can penetrate the market so easily, it tells me that investors are very risk-taking, are more risk-taking than they should otherwise be, because the AI boom occurred, and markets didn't really suffer a recession, even though interest rates went up 5.5% or 5.25%. A lot of analysts were out there saying maybe recessions are a thing of the past. We're not going to have a setback. This is today's proof is in the pudding. Look at this, interest rates went up, markets were supposed to crack, but they didn't crack. Things are great. But an important point is the fact that interest rates were expected to cut or be cut, which is why certain people had a false sense of security staying in the market. But that doesn't mean interest rates have to be cut. The Federal Reserve doesn't have to listen to anyone. I mean, people calling for the Federal Reserve to cut interest rates immediately to give some relief is nonsense, because the Federal Reserve doesn't have to listen to you.
It doesn't even have to listen to the president.
Yeah, its only job is to control the inflation rate and to keep one eye on unemployment data.
Yes,
if both of
that's its mandate.
Yeah, that's its mandate. And if both of these things are taken care of, then I don't see why the Federal Reserve needs to listen to anyone. So I have to say that most people have a false sense of security. And
you know what it looks like to me? It reminds me of the football game. The referee is there, and you see the player, one guy nudging one guy, and he falls down and he's hurt. And his teammates will run to the referee and say,
yeah.
And the referee is fed, he's just looking straight, stoic. And they're and they can't touch him, they can't go too close to him. They're please, 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 look. Please see what he did. What he did. The participants in the market seem to be doing that with the Fed. They seem to be knocking on Powell's door saying,
Yeah.
see, going to all voice boxes and TV boxes and screaming, do something, do something, do something.
I mean, if anything you take away from this video, I'd like you to take away this one line, which is that equity markets still remain very expensive relative to firms' underlying earnings compared to almost any point in history.
And I'll tell you what the problem also is. Someone who is over leveraged, who's borrowed money or done something in the market, and they need to exit, and they're selling their gold to hold on to their position, is because they strongly believe from here it's still going to grow. That has not broken in the market. That what has to change is people have to realize it is what they're holding is not of value, or at least not of the value they think it is. Because their fear is, if I let go of this, I might not be able to buy it back at this price. I rather let go of gold.
Yeah.
I don't need gold. Gold doesn't earn me anything. No dividends, nothing. There's no growth. Like the growth I can see here. So that mentality has to break. And the second thing that has to break is, even if someone says, oh no, this is too expensive and throws it away, there's a bunch of other guys who have been sitting in the wings with heavy liquidity who are ready to swoop in and put the scaffolding back at these prices.
Yeah.
Huge guys, huge institutional investors, funds, pension funds, everybody. I got to realize something like a pension fund or an insurance company, they give their mandate to someone, private guy, and that guy has like a playground. He's like a kid who's been set into the candy shop and he can do what he wants with it. There's no committee sitting and approving each and every investment. They hand it over to a guy and then they say, okay, take care of it, offer me so much returns, promise me you'll get me at least this much. That's his mandate. And he's allowed to do whatever he wants. Take future option bets, do whatever monkey tricks he wants to get that return for the pension fund, because they in turn have to pay pension.
Yeah.
So all these kinds of mandates interlock. So that is why you're not seeing, it is obvious it should correct. When you're asking why is it not correcting? Why is it just bouncing one day and going back? Because there's so much of pressure being piled on for other reasons and everybody seems to be beating the same camel. That's a problem.
Yeah, and one thing to note is that interest rates being at 5.5% is still very vicious. Will hurt because let's say today there is a sizable investment fund which is unable to meet its margin calls. They will not be able to raise cash at the rate which they want to raise cash at.
Correct.
And no one's going to lend to them.
It is like driving around in a bike where the petrol tube has a small drip leak going on. That's why interest rates leaking.
Yeah.
You would be going thinking you have filled your tank, but little do you know, halfway down to your journey, suddenly you'll open and tank will be empty.
Yeah.
And that's going to happen to a lot of people very soon.
So that's where we stand today, and we hope all of you are investing. Continue to stay as investors and don't get scared. But at the same time, please do dollar cost averaging. Don't invest large amounts of money.
Like Anand says, stiffen coffee. Even if you're investing in the US market, stay within your range. Don't get excited when you read some news, some takeover news, and you think some share is going to spike. And when we are talking about a certain company or please watch the whole video, understand what our motivation is behind any idea we're projecting to you. And then you move based on your risk assessment. And if you decide to do something by yourself, well and good, but make sure you've done adequate research and you've consulted enough people before you decide to do something.
We are not SEBI registered.
Anything or anything. Yeah, which is purely what we're having is an intellectual conversation.
So that being said, we hope you enjoyed this video. Please like the video if you enjoyed it. Please subscribe and hit the bell icon to get notified of when we drop our latest videos. And finally, if you have any thoughts, any opinions you want to express, please leave them in the comments section below. And thank you again for watching Viraj.
Thank you.
I told you about visiting Singapore. The date has been finalized. It's 25th August. It's a Sunday. Those desirous of meeting me in Singapore can drop a message to the WhatsApp number given below or contact my team by an email. My team would reach out to you and we will assure you of our best services. For English and Hindi, there will be a separate meeting. See you in Singapore. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, Those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.